Welcome to the Everyday Investor Podcast. Today I'm talking with the resource sector's most hated contrarian investor, Rick Rule. What's next for gold, silver, uranium, and even oil and gas? That's only part of what we're covering. We're also going to be talking about what he believes the ultimate form of digital money will be. And we're also talking about his vision for a world where precious metals lending becomes mainstream. Hope you enjoy. Please like and subscribe on the way through. Let's get started. Joining me is Rick Rule, who founded Global Resource Investments, led it through to its acquisition by Sprott, where he became president and CEO of Sprott US Holdings until 2021. And now, after five decades practicing as the resource sector's leading contrarian investor, he's co-founder of Battle Bank, which unique offerings include precious metals lending. How did I do, Rick? And how are you?
That's a fairly good introductory
Good
session.
stuff.
Thank you, and I'm delighted to be here. Delighted to be here on air with you.
Fantastic, fantastic. Let's start with the U.S. debt. So just recently crossed $38 trillion in October of 2025, and I've heard you say that the only way to honor this is through a stealth default strategy by destroying the dollar's purchasing power. So my first question to you is this underway already, or are we in the early innings of a stealth default?
That's a great question. Since the establishment of the Federal Reserve in 1913, according to the St. Louis Fed, the U.S. dollar has lost 97% of its purchasing power. So to say that that phenomenon is something new ignores a lot of history. It's my belief that the next 10 years will see us destroy 75% of the 3% that's left. Let me tell you a little bit about why. The on balance sheet liabilities that you described, 37 trillion, are ugly enough. Note that that number needs to be reduced perhaps by 7 trillion, which is the Fed's own balance sheet. In other words, they have a lot of paper on their own balance sheet, but 31 is pretty bad. The truly ugly number, Darcy, is the net present value of unfunded entitlement liabilities. Debts that are off balance sheet, but promises that have been made to old codgers like me, Medicaid, Social Security, military pensions, federal pensions. That number, the net present value, not nominal number, that number, according to the Congressional Budget Office, is $120 trillion. So you add 31 trillion, let's round it down to 30. And you add that to 120 trillion, the headline debt of the US government, not including state and local governments, is $150 trillion. Now let's put that in perspective. The Internal Revenue Service suggests that the aggregate net worth of all American citizens combined is 167 trillion. So we're worth 167 trillion and we owe 150 trillion. And that 150 trillion gets worse by $2 trillion a year on balance sheet and $2 trillion a year off balance sheet. And that number needs to be put in the context of the fact that the gross revenues of the US government, before they spend a dime, are $5 trillion. So we take in 5 trillion and we increase the debt by 4 trillion and we owe 150 trillion. So let your listeners ask themselves, what do they think the alternatives are?
That's a good question. Because really, there is no alternative, right? Like the only way is to make the debt appear smaller in the rear view than it does in front of you, which is to race beyond it and inflate it away, right? Like that has to be the only option. And that's kind of what you're alluding to, right? Is that this is kind of where
Well,
things are going by default.
there are two ways around this. You could do what Argentina used to do. They were honest. They just default. They'd
Yeah.
send their creditors a letter saying, yeah, I know we borrowed it. I know we owe it. Too bad, so sad. No money, strong letter to follow. Or that's not the American way. Or you can merely lie. You can honor the nominal obligation by inflating away the net present value of the obligation. We did that once before in the decade of the 70s, and it worked fairly well. It was unpleasant to go through.
Yeah. And in the 70s, the US dollar lost around 75% of its purchasing power, and gold ran up around 30-fold. So are we actually mirroring that decade?
Well,
Or,
I think it's important for people to realize that gold's already up 12-fold since the year 2000. So I'm not, and also realize that in the 1970s, part of that move was due to the fact that gold had been price controlled. What
yeah,
I'm suggesting is that the nominal price of gold, the US dollar price of gold, probably mirrors the decline in the purchasing power of the US dollar. Will gold increase threefold or fourfold? I don't know. My crystal ball is cracked and cloudy. It only makes arithmetic sense that gold priced in dollars will increase in a fashion that mirrors the decrease in the absolute purchasing power of the US dollar. By the way, I don't think that the US dollar needs do poorly against other fiat currencies. My friend Doug Casey once said the US dollar is the worst currency in the world, with the sole exception of all of the others. So I'm not
yeah.
suggesting to you that the US dollar does poorly compared to the Canadian dollar, the New Zealand dollar, the euro, the pound. I'm just saying in an absolute sense that there's going to be a reckoning.
And what does that mean then for the rest of the world if they're the dirtier shirts in the laundry?
Not necessarily dirtier shirts, but I've heard people say, well, Rick, would you then advocate buying Australian dollars or Canadian dollars? No, I wouldn't. I would advocate buying investments in companies that traditionally have pricing power and owning baskets of goods that do well during times of inflation. I don't think that you can sit out a sovereign crisis in a sovereign. So I'm not recommending, as an example,
Right.
long British bonds, long Euro bonds, or for that matter, long Kiwi bonds.
Gotcha. Okay. So if we are just thinking about the next 10 years where there's a 75% loss of purchasing power, that's probably not going to be a linear trajectory,
Correct.
is it? So
Correct.
what tell me a little bit more about what you think will actually play out in terms of the volatility of that story.
I'm not smart enough to time the volatility, but I have a very good memory. In the decade of the 70s, and by the way, I was around and in the game then, that decade was spectacular for gold. It went from $35 to $850. Many people don't remember that in the middle of that bull market in 1975, we had a what I would call cyclical decline in a secular bull market in 1975, where the gold price fell by half and the prices of gold equities were even more dramatically impacted. People who
Mm,
got shaken out missed an eightfold increase in the gold price over 5 years. So it's important that if people are moved by the arithmetic behind my thesis, that they understand that they will have to endure both volatility and cyclicality. There
mm,
will absolutely be a time in the next 10 years where the gold price falls momentarily by 20 or 30 or 40%. That
mm,
will occur. It's important to understand the arithmetic as opposed to the narrative so that you have the
mm.
psychological and financial ability to stay the trade as opposed to being shaken out the way hundreds of thousands of people did in 1975.
So when you say understanding the arithmetic, you're just suggesting that we should be more mindful, not of the narrative around what's driving gold price right now, but the amount of drawdowns that we've seen in the past, right?
Yeah, I mean, if the gold price were to fall, let's say next February, the price of gold was to fall from 4,000 to 3,000. A lot of people who today characterize themselves as gold bugs would wish they never learned to spell gold. But that price decline will not in any way, shape or form change the arithmetic around the US dollar or the probability of a soft default. Uh, Gold, I would suggest, if it fell by 25%, which would scare people out, would be a substantially better buy after than
Yeah.
before because the
Yeah.
outcome's the same, irrespective of the near term price movement.
And then what happens at the end of this uh, stealth default or soft default? Are we going to see a currency reset, or are we just going to see things somehow magically normalize?
I don't know about magically. We did it the last time because we elected uh, a guy who promised to cut the size of government. He didn't actually accomplish that. Mr. Reagan, however, did slow the rate of growth.
Yeah.
At the same time, he allowed Paul Volcker the latitude to allow the interest rate to rise. By the way, Paul Volcker didn't raise the interest rate. He merely allowed market forces to take the interest rate up at a rate faster than inflation, which broke the back of inflation. Breaking the back of inflation and the subsequent ability over the next 10 years to lower the real interest rate meant that the US economy went on a real tear. And the
Mm.
economy grew much faster than debt and deficits, ushering in, I would suggest, a golden age from 1982 to 2022. We need to work
Mm.
our way through all that again. We need to reduce the net present value of our obligations. We
Yeah.
do that by devaluing the dollar at the same time that we don't index revenues, which is to say taxation for inflation. In other words, we steal more from our citizenry while we give them less.
Right.
And I suspect that we will need to ultimately tamper somehow, probably via interest rates,
Mm.
inflation. The difficulty is our total government debt as a percentage of GDP is much higher. That is, the ability that we have to survive this without extraordinary measures is much less than it was in 1970, and certainly much less than it was in the good times around 1982. In
Yeah.
1982, on balance sheet liabilities in the United States government were about 33% of GDP. Now they're about 120.
Yeah. Right.
But the real problem are the off balance sheet liabilities, the $120 trillion in net present value. That number is
Yeah.
over 4 times
Yeah.
GDP. And that's a truly ugly number.
Yeah.
Now, we're going to have to do a lot of things around that, Darcy.
Yeah.
We're going to have to twiddle with the formulas. When Social Security was instituted, and this is hugely politically unpopular, when Social Security was instituted, it provided you basically poverty level subsistence uh, beginning at age 65, and the average life expectancy of an American male was 66 years.
Good deal.
That's no longer the case. And so we're going to have to fool around with the eligibility age. Um, and despite the fact that Social Security is sold as an insurance program, that's a lie. It's an income transfer. And we're going to have to face that. Old rich guys like me
Mm.
are going to see the cap come off their Social Security contribution,
Yeah.
despite the fact that they're going to means test it. In other words, they're going to take the income tax cap off Social Security, drastically raising the taxes on wealthy people, while at the same time denying wealthy people the benefit.
Yeah.
This will be hugely unpopular, and it's absolutely positively going to happen.
Yeah. It
Uh,
just feels though, like in so many ways, all the things that we have to do, the things that are inevitable, and I'm speaking not just as a US, but in any Western country, it feels like the types of government that the majority of the next generations are prone to elect seem like the types of governments that would not have the backbone to put these things in place. They would be more likely to give people what they want, which unfortunately is not the kind of medicine that we need to get to this place, though.
well, that's right. I think it was Churchill that said about Americans, they always do the right thing when they've exhausted all of the other alternatives. I pray that that's
Yeah,
true.
we'll see. We'll see. So, moving on to central banks, over the last 4 years, I've read that each year about 1,000 tons of gold have flown through to central banks. Unfortunately, not the Reserve Bank of New Zealand, where I live, not that I'm aware of anyway.
Right.
And I'm curious, like from your point of view, does this mean that central banks are preparing for something? Is this just the dollar value of their gold holdings increasing? Is this just the symptom of loss of confidence in U.S. Treasuries? What's the rationale there? Do you think?
Yes, yes, and yes.
Okay.
Um, I think that political moves in the United States, not just Trump's, but political moves in the United States going all the way back to the Obama administration, uh, have necessitated foreign governments saving in gold. The weaponization of the SWIFT banking system by the United States. The SWIFT banking system is not a U.S. possession. Irrespective of what you believe about the efficacy of Russia's actions in the Ukraine, the theft by the U.S. government of $300 billion worth of Russian assets in U.S. treasuries gives administrations around the world that might not agree with all of U.S. foreign policy pause. The United States, has weaponized the dollar in a way that makes the dollar an unattractive store of wealth for foreign governments. Separately, the US dollar was a wonderful exchange mechanism between countries that didn't trust each other. And they still don't trust each other. The last thing that the Chinese want is $100 billion worth of worthless rubles or worthless reals or worthless pesos. The world is beginning to gear up for a period where, at least partially, gold is not merely a store of value, but also a medium of sovereign exchange. And the third thing is, arithmetically, the US Treasury is a lousy deal because it pays, from my point of view, a negative interest rate. And let me explain this.
Mm-hmm.
Americans, at least, but I think people around the world too, are hoodwinked into believing that the CPI in the US is an accurate measure of the deterioration of the purchasing power of the US dollar, which is hogwash. Since 2020, the basket of goods and services that I personally consume, and I'm an old cheapskate, I don't buy much, uh, suggests to me that the purchasing power of my dollars is deteriorating at about 8% compounded. The CPI is an example. When it's inconvenient, doesn't include food or fuel. I'm a guy who likes to eat. Any index which doesn't include lunch is of no use to me whatsoever. Then the index is subject to hedonic adjustments, which meant that the folks who compile the index tell you what the value of the goods that you've bought are, irrespective of price. And then finally, most laughably, the CPI doesn't include tax, the largest single household expense of Americans. So getting back to your thing about the foreigners, they're asked to buy the US 10-year treasury yielding 4.5 in a currency where the purchasing power is declining at 8. That means if they lend the US government $1 million for 10 years, the US government promises to give them back $600,000 in purchasing power. Owning the US Treasury, it is a guaranteed loss.
Right. Often investors, and I've seen this with mainstream portfolios as well. The reason why 60-40 portfolio exists, right, is because of this assumption that the CPI is the CP truth, right? But it's not, it's
Right.
the CP lie.
Correct.
And it's interesting because we're seeing a lot of well-known firms now coming out and increasing their recommended gold allocations roughly around the same time that central banks are increasing their allocation. So don't do what they say, do what they do, right? Seems to be one of those things.
It's ironic that the writing on the wall for this circumstance was pretty available decades ago. And in fact, if you ask these mainstream Wall Street guys, they weren't paying attention to gold because there were no fees in it. They would suggest that the gold bull market began 2 years ago. The truth is that I've been saving in gold. I maintain liquidity in US dollars, but I save in gold. I've been saving in gold since the turn of the century, turn of the millennium, which is to say,
Yeah.
since the year 2000. In my case, the value of my gold holdings has been increasing at something like 9.2, 9.3% compound annualized for 25 years. And I maintain as a thought experiment an alternative ledger, a balance sheet, and income statement in gold. And when you do that, you're struck by how cheap things are. In gold terms, house prices are cheap, food is cheap, gasoline is damn near free. It's odd that when I look at my ledger in US dollars, I say, oh my God, stuff is expensive. And when I look at the same expenses measured in gold terms versus the year 2000, when I started saving in gold, I think, God, stuff is cheap. And I suspect that that circumstance is the same in New Zealand.
100%. Hey, quick interruption in this podcast discussion with Rick Rule. If you're looking for greater choice within your KiwiSaver, which might include exposure to oil and gas, precious metals like gold, silver, and platinum, and other alternative investments, although it does come with much higher degrees of volatility, then reach out to me for a quick chat to see how I work in the area of KiwiSaver. Link is in the notes. Let's get back to the show. And I think a lot of us, when confronted with rising costs, we just think we need more of it, right? But it's not a quantitative solution. In my view, it's a qualitative solution. Things do get cheaper if you pursue finite money rather than infinite money.
Correct.
And I think a lot of Bitcoiners will say this as well, that things actually, when you start thinking and behaving in a Bitcoin standard or a sound money standard, let's say, things do genuinely get cheaper. So how do you think about gold then? You mentioned that you effectively save in gold. So do you see gold as like a savings technology? Do you see it as a hedge? Do you see it as insurance, or do you see it as an investment?
It depends on who you are. I save in gold. I think of it sort of as an insurance product, but insurance against the depreciation, the purchasing power of the US dollar. I maintain liquidity in dollars in very, very short-term treasuries, but I personally save in gold. I invest in high quality gold stocks. I'm willing to take operational risk in those companies because I believe that an increase in the gold price increases their margins faster than it increases their cost. And I speculate in higher risk, lower quality gold companies. So the gold sector fulfills all three roles for me. I save, I invest, and I speculate across those three asset buckets within the so-called gold group.
Right. And specifically, we're talking about gold miners and then junior miners.
Correct.
Right.
Correct.
Okay, so I want to not fixate too much on gold and talk a little bit about silver. I'm a huge fan of silver, have been for quite a few years, and I don't think I've been looking at it quite correct. After I've been watching a few videos of you recently, I think I need to update my thinking on it. So there's one thing that you mentioned, we call it the silver price paradox, where higher prices typically reduce demand, but in silver bull markets, the opposite seems to happen. So can you cover that for me? Explain that to me.
The silver price paradox has to do with the fact that silver is both a monetary metal, I believe, and an industrial metal. People who are making a case for silver as a monetary metal forget the fact that the increased nominal price of silver reduces its utility in industry, and the increase in the price of silver reduces its industrial demand and cannibalizes that demand. At the same time, that on the monetary side, silver is a Geffen good, which is to say that as the price increases, that increase in price validates the narrative. It's a
Right.
very, very odd metal. I've studied the silver market for 50 years, and I need to disclaim at some point in time in this answer that after 50 years of study, I'm not sure I understand it. Understanding silver supply is hard because silver mostly doesn't come out of silver mines. It comes out of recycling or gold mines or copper mines or lead mines or zinc mines. So to understand supply in silver, you have to focus less on the price of silver and more on supply and demand for things like copper, lead, and zinc.
Mm.
So getting an accurate supply handle is hard. It's hard too because a whole bunch of silver doesn't show up anymore anywhere. A whole bunch of silver is owned by private owners in India, Pakistan, Bangladesh. They don't want to be taxed on it. And so it's unreported. When the price of silver, particularly in US dollar terms, goes up and the rupiah falls against the US dollar, times like right now, um, incredible price escalation in Indian terms. And that sometimes leads some supply to come out on the market. And the demand side has been hard for me to understand. What I know about the demand side as a monetary metal is this: precious metals bull markets are led by gold, always. They're led by the fear buyer. And the price escalation has to do with the absence of selling, which is to say the sellers get used up. And when the fear buyers emerge, they can take the price of gold up relatively rapidly. When the price action in gold, when the momentum in gold has justified the hard money narrative to generalist investors, not precious metals investors, but the generalist investors, which is precisely what you're seeing right now. Bank of America, Merrill Lynch, Goldman Sachs, all those guys.
Yeah.
When the generalist investors come into our space, precious metals, leadership changes from gold, from the fear buyer, to silver for the greed buyer. I don't know
Interesting.
why this is, Darcy. I suspect it's because of the lower unit cost,
Mm-hmm.
or perhaps because of silver's reputation for volatility, or both.
Yeah.
All I
Yeah.
know is that in the three precious metals bull markets that I've survived prior to this one,
Yeah.
at some point in time when the generalists came into this space, gold, silver began to outpace gold. The last 4 or 5 weeks might suggest that we're in that period now, leaving the last week out of it.
Yeah.
This I know. Uh, when that happens, when the uncoupling happens, and I think it's when, not if, you won't need Rick Rule to tell you it's occurring. Those are dramatic circumstances. I've had the pleasure of living through that 3 times long, and I'm hoping to live through one more event like that.
Right. Yeah. Like going back to what you said in 1975 with gold, where effectively there was like a 50% pullback. With silver, what are we going to see there then if when the generalist shows up, which they might be doing now, if it really starts to take off, what kind of volatility then should we be prepared for if we are a long-term silver holder and we want to get the most out of what's coming? And I
Uh, I,
guess by default,
I
like
never have
when do we exit, right?
I never have the courage uh, to hold through the whole upside blow off. That's just not what I do. So I really can't answer the question. I'm reminded of that great Bernard Baruch quote: "The only guy who ever got in at the bottom and sold at the top was a liar. It didn't happen." And so I would encourage people, rather than to try to top tick this thing, to take themselves a fat slug out of the
Yeah.
middle. Um, in my experience, when the gold and silver price decouples, that the silver price outperforms the gold price about 2 to 1. From a conjectural perspective, then, if I was one who believes that the gold price should go up threefold in the next 10 years, that would suggest that the gold price goes up sixfold.
The silver
Is
price
that
will.
a
Yeah.
projection? I'm not smart enough to give you one. I'm just repeating history as I've lived through it. I don't
Yeah.
know how. I don't know why. I just
Yeah.
know that.
Interesting. Okay. Let's maybe just unpack another phrase that I've heard you say, monetary metal in drag. I've heard you use that phrase when it comes to describing silver and as it relates to like actually using silver as a medium of exchange. I'm quite interested in this idea because obviously it's a really heavy metal. If you were going to carry a whole pocket full of that, it's going to be pretty awkward. But I've heard you talk about tokenization and
Yeah,
how it might be used at some stages with transactional use. So can you just expand a little bit on what you see there maybe happening?
not white, not might, it will.
Okay.
Silver is, as we speak, a medium of exchange in rural India, Pakistan, and Bangladesh. Not an official medium of exchange, and it's impractical, as you suggest. It's heavy. People can steal it from you. It's difficult to make change in.
Mm.
But in uh, illiquid societies, or in societies where a lot of transactions take place, let's just say off balance sheet, it's already a medium of exchange. It's important to know that. Tethered tokenization and coinage, that is to say, crypto coinage, changes really, truly everything.
Yeah.
The technology exists today for a gold token. And I think that the regulation and the infrastructure will exist within 2 years,
Wow.
where you will have precious metals stored in a recognized exchange, that is to say, a recognized vault, and what are in effect delivery receipts, which are redeemable for physical precious metals, will be established in trusts and then tokenized. I know that the World Gold Council and the LBMA is working on that as we speak. I know that the technology exists. Regulatory adaptation will be slow because governments understand that good money drives bad money out of circulation.
Yeah.
But the first time a country breaks, Liechtenstein or anywhere else, and you have a gold token or a silver token where you can walk into a Starbucks and pay for your coffee in a fraction of a gram of silver, and where the merchant can store up those fractionalized payments and redeem them for physical silver if he or she wants. The transaction costs around transactions and the transaction costs around storing silver become much, much, much more efficient. And the metal becomes then what it was 100 years ago, which is to say, both a medium of exchange and a store of value. And as I say, the technology for this exists today. I
Is
think the biggest private buyer of gold in the world right now is Tether, using it to secure a stable coin.
yeah,
And the whole technology around issuing securities redeemable in gold was pioneered by us at Sprott.
yeah,
That's now a $40 billion business.
yeah,
We would buy physical gold, silver, platinum, palladium, stick it in the Royal Canadian Mint. We used to joke, by the way, our security was provided by NATO. And then we would sell trust units, which were, in quantity at least, redeemable for physical gold, silver, or platinum and palladium. Importantly for American investors, and this was an afterthought, but it turned out to be very beneficial, in the US, transactions in gold and silver are characterized by the IRS as collectibles, and they're taxed at the income rate. But the trust units are taxed as securities at the capital gains rate.
yeah,
But the point of it is that the practice of storing gold in a recognized exchange facility and having it redeemable and having audit procedures in place all exists today. This doesn't need to be invented.
interesting. And going back to the very start where I introduced you as co-founder of the Battle Bank, where you are or will be, I'm not quite sure where you're at with that, but you're offering um, precious metals lending. Is that kind of the beginning of where the strategy might go with the bank, where you might get involved in that a little bit more?
I mean, I think that effort will be led by the COMEX, by the LBMA, by the World Gold Council. I
Yeah,
suspect among financial services people will be first users because we care.
yeah,
Gold is a small business. The guys at Goldman Sachs just very recently learned how to spell gold, despite the fact there's only 4 letters in it.
yeah,
Um, our bank uh, has been formed by and for, among other things, gold bugs.
yeah,
There are now 19,000 people on our wait list before we even open the bank. We know how to talk to the gold community, and we are right now the only bank in the United States that I know of that will establish credit facilities against bullion inventories in amounts less than $10 million. Our competitor is JP Morgan Chase, who has, as I understand it, a $10 million minimum. We will have a $100,000 minimum, and we will lower that as we get scale. So I would suspect that for our community, the 505,000 Americans who pay for investment advice, as an example about gold, that
yeah,
will be the leading practitioner in this business.
yeah.
It won't be an afterthought for us.
Right. That's pretty cool. And again, parallels everywhere with the Bitcoin space as well, where just because you own Bitcoin and it goes up to infinity, what's the point if you don't actually benefit along the way? And I guess this is an example where if you could deposit your gold in a vault, borrow against it, just like you can now with Bitcoin, then yeah, you can effectively spend tax free using that secured asset. And
And you can become your own bank.
exactly,
This is
yeah,
important. Rich people have been doing this kind of thing for years. If you have $1 million worth of gold, and like me, you've been buying it since the year 2000, A, you don't want to sell it because it's a store of value, but also you don't want to sell it because you don't want to pay the capital gains tax. But
Correct.
let's say the opportunity comes up to put a down payment on a distressed duplex or triplex in your neighborhood. You really want to buy this thing, but you don't want to sell your gold. Fine.
Yeah.
Borrow against your gold, buy the duplex or triplex, improve it 4 or 5 years out, finance out of it,
Yeah.
and repay the loan. It's designed to allow prudent investors access to the capital that they have tied up in their physical gold and silver without making them sell their physical
Yeah.
gold and silver.
Yeah. And I guess in a way that would increase the hurdle rate as well, right? Because you're going to be looking for a rate of return on whatever that project is, which
Sure.
exceeds the rate of return of just holding the gold, right?
Or doesn't, but it allows you to diversify the use of the capital. Now, I
Yeah.
suspect, without knowing, that a reasonable number of people who play the game harder than I will borrow money against their gold and silver to buy gold and silver. That isn't what the product is designed for, but it isn't any of my business to tell somebody what to do with their money as long as I, as the lender, am adequately secured.
Understood. Okay. And one more question around this tokenized gold or tokenized silver in this case. Do you think that that could be, because you seem to have quite a high conviction that that's going to happen? Do you think that that could be yet one other strategy that everyday people can use to potentially prepare for a world where there is some sort of central bank issued digital currency or digital ID sort of control system going on?
I
Or-
absolutely do. And I
okay.
absolutely think that people need to prepare for that. The combination of AI, social credit scoring, and a central bank digital currency is the worst possible Orwellian outcome I could imagine. And I think it's inevitable. My hope is that there are a plethora of digital currencies. The idea that there's a bunch of smart people out there designing a bunch of currencies, since I'm a consumer of currencies, is my fondest dream. If my country chooses to treat me poorly, but Liechtenstein and Dubai choose to treat me well, while I live in the United States as a medium of exchange,
Yeah.
I might prefer to use currency from Dubai or Liechtenstein. If I had the opportunity, probably, rather than that, I would choose to utilize as a medium of exchange my store of value, which is to say gold or silver. I believe, by the way, that the blockchain will allow people to use indexes as a medium of exchange. I think the S&P 500 will have a tethered coin, and I believe that you will be able to pay for a cup of coffee with a fractional unit of the S&P 500. In that
Yeah.
sense, we
Great.
have a wonderful, if confusing, world coming with lots of choices, many more than we've had in
Yeah.
the past.
Yeah. It's the digital transformation of value, and it's going to be pretty cool, I think. All right, now to bring this in for a landing, I'm completely a newbie when it comes to uranium. Only just this year have I been kind of cautiously scaling into it and learning more about it. And I know a lot of people are kind of interested in that at the moment. Can you just give me a real high level overview on what an everyday investor might want to consider in terms of the macro drivers at play that support holding uranium right now?
The world needs more of all types of energy, zero doubt. The International Energy Agency has suggested that global energy demand uh, will increase by 100%. In other words, will double in 25 years. That means we're going to need more of all forms of energy. And this is not just about AI and electric vehicles. This is about a billion poor people on Earth having no access to primary electricity at all. We've done a great job, by the way, in the last 40 years, moving 2 billion people from being extraordinarily poor to merely poor. And we're going to finish the job in the next 25 years.
Yeah.
We're going to electrify the whole world, which brings in a million new consumer, a billion new consumers, pardon me.
Mm.
So are we going to need more wind, which I make fun of all the time? Yep. Solar?
Yeah.
Yep, that too. Oil and gas? To be sure. Coal, whether or not the big thinkers like it? Yes. But I think the big winner will be nuclear. It is a source of cheap, reliable baseload power that generates no carbon. People who used to be really, really, really opposed to nuclear, including the co-founder of Greenpeace, and even Joe Biden, have suddenly become pro-nuke. The change in perception around nuclear has been the oddest financial change literally in my lifetime. 5 years ago, as an outspoken proponent of nuclear power, I was fairly widely vilified. They compared me to a profiteer on Hiroshima and Nagasaki and 3 Mile Island and Fukushima. And now those same morons want to subsidize me. In 5 years, I've gone from a poster boy on a post office wall, America's Most Wanted, to being deemed worthy of subsidy. Now, I felt cleaner when I was vilified, to be honest with you.
Yeah.
But it talks about the permissive nature of the new zeitgeist. Uh, we went through a bad pun, a nuclear winter, really beginning with Chernobyl, and then again after Fukushima. And the consequence of that is that for 35 years, we haven't invested enough in uranium supply. And we can't address that overnight. Meanwhile, uranium demand is going through the roof. And by the way, we haven't really started building the reactors, which allegedly are going to power these AI centers. Despite the fact that the AI users, the Microsofts of the world, are entering into long-term supply contracts at twice the regular cost of power to lock in guaranteed supply that doesn't generate carbon. Now, this takes place over time. And somebody who isn't prepared to stay in the trade for 3 to 5 years should not get in the trade. The uranium stocks are uniformly up massively. The easy speculative money has been made. It's made when a commodity goes from being hated, which is the time a speculator is supposed to buy, to the time when it's merely tolerated. And it's beyond tolerated. So I would suggest that if you're a speculator, if you're interested in the short-term time frame, that the time has passed you for uranium. If you are an investor, the sure money is ahead of you. We haven't yet met that point where demand greatly outcreases supply, and there's no way to make up the shortfall in the near term. You may know that a group of us many years ago formed something called Uranium Participation Corp in Canada. And then when I was at Sprott, we bought control of that. Uranium Participation Corp is a vehicle that buys physical uranium and stores it with a view to price increase, but they never, by their charter, sell it. Uranium Participation Corp has now taken something like 75 million pounds of supply and put it in supply heaven. It's gone. It's off the market. When people look at total uranium supplies, they look at that 75 million pounds and they hold it in their own minds as available for sale, which is fine, except it's not available for sale. It's gone. Now, it may be that 5 years from now, or 6 years from now, or 10 years from now, that uranium has such strategic importance that some buyer or group of buyers bids us a big premium for that uranium, and we sell them to trust. We liquidate it. But in the near term, trust is sacrosanct. Those pounds are gone.
Wow. Okay. And going forward, what is your most hated contrarian play?
For most people, it's oil. That noted energy physicist Greta Thunberg has said that peak oil demand occurs in 2030, echoing Mr. Biden and the noted German economist Angela Merkel. A whole chorus of morons has suggested that we're going to stop burning oil. The problem with that is it's not true. People point to the rise of the electric vehicle, pardon me, without understanding that petroleum use for existing vehicles increases every year, despite the increase in the number of electric vehicles. And they forget that we're going to need more of all kinds of power. We need to ask Ms. Merkel and Ms. Thornburg what they will use to power their jets when they fly to Davos to tell us to drive less. Uh, Jets, as you know, can't take too much weight. Batteries don't work real well up there. So that's going to be a challenge. You know, I'm, by the way, not hostile to alternative energy sources. I've invested in wind and solar and high head hydro, low head hydro, all those kind of things. But it's important when you consider the impact of alternative energies on carbon that it's now reported, and I used to way understate this number, it's now been reported that private and public sectors have over 50 years invested almost $11 trillion in alternative energies. And they have, over 45 or 50 years, reduced the market share of carbon from 83% of total energy all the way down to 81%. An $11 trillion investment generated 2% change in market share. When people talk about that increasing in the future, they need to understand that China produces more carbon than the Western world combined now. And from the point of view of emerging markets or recently emerged markets like China, carbon consumption shouldn't be measured per country. In other words, you shouldn't allocate a quota to New Zealand or to the United States, that it should be done per capita. In other words, countries with a larger number of capitas get to produce more carbon. Now, guess what that does to the carbon quota for rich Western nations? But the emerging markets promote something which I think is even wiser from their point of view. They point out that most of the carbon in the atmosphere that people are concerned about is historic. And the Western world generated almost all of that carbon loading. So emerging markets suggest that carbon quotas in the future should take into account not merely per capita consumption, but also historic production of carbon. If you want to know what that future looks like, just look at Germany, where the grid changed from reliable nuclear to other forms of energy, ironically, including coal, and where the grid became less stable and the price of energy increased by 500%. Ask yourself in New Zealand how well your recently retired prime minister would have done had she said, as a consequence of my policy, I guarantee that your power rates are going up by 500%. In other words, had she been kind enough to honestly state the direction that her policies would have taken New Zealand. That's the dilemma that faces the anti-oil politically elite. There is no way that they can accommodate their goals without substantially diminishing the material standard of living of their voters. And voters are very intolerant of substantially diminishing their material standard of living.
Yeah, it's just unfortunate. It takes a while before that diminished standard of living to catch up with the words that they threw at us before, right?
Correct.
Wow. That was a good conversation, Rick. We could probably talk for a lot longer. Now, last question. I promised that was the last question, but I always lie. When are you going to be retiring back here in New Zealand? Are you gonna move here someday in the future, or is it Florida forever from here?
I live in Washington State now,
Sorry, my
and
apologies.
I sort of hope I pass out my time here. I greatly enjoyed my time in New Zealand. Uh, Dealing with your Foreign Investment Review Act was a consistent challenge for me. I'm being polite. The idea that the New Zealand political establishment had that my property was in fact theirs is not something that I particularly enjoyed. But I must
Right.
say, while I really disliked New Zealand politics, I really liked New Zealanders.
Yeah.
If you talk to New Zealanders on an individual basis, particularly in the rural parts of New Zealand, it made it an astonishingly pleasant place to live.
Yeah.
Consequence of all that is that I will likely visit there. I've learned I'm American by culture.
Yeah.
And if I was going to move outside the United States now, I would either be part of that grand experiment called Argentina,
Yeah.
or I would probably move to Liechtenstein, where the prince who runs the country said that he regards his citizens as customers, not chattel.
Sounds like a dream. Sounds like a dream. Let's pray that that kind of catches on, right? I don't know if it'll
Correct.
will. Don't know if it will. That's awesome. Well, as I leave you, where can people go if they want to get some more goodness from Rick Rule in terms of following what you put out there?
Three ways to find me, depending on what your definition of goodness is. The first is if you like what I say about natural resource investing, you can personalize it. If you go to my website, ruleinvestmentmedia.com, that's all one word, Rule Investment Media, you can list your natural resource stocks, and I personally will rank them 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues if I think my comments might have value. There's no charge and no obligation for this. It's free, a very good price. If you want to know how I derive my rankings, if you want to know how to rate your own natural resource stocks, you can go to another website of mine called the Rule Classroom. It is also free. At the Rule Classroom, you'll find over 250 hours of instructional programming, including 6.5 hours on how to value natural resource companies. Most Thursdays, there's a free hour-long question and answer session where you can pepper me with your nosy questions about your stocks, and I'll do my best to answer them. Finally, if you're in the United States or Canada, this January, and you're unhappy with your current bank, which I suspect is all of your listeners, my bank, Battle Bank, will be open. You can go to battlebank.com to learn more. Our last bank, Everbank, ultimately was able to accept customers from 28 countries, including Australia and New Zealand. We're starting with the United States and Canada, but we will add other countries as their regulators permit us to enter them.
Well, thank you so much. You've been really generous with your time, especially when I reached out to you from this corner of the world. So I appreciate that, Rick, and hopefully we'll catch up with you again soon.
Well, I'm extremely fond of that corner of the world, as you know, and I've enjoyed this process. So thank you for having me on.
Thank you. Cheers.